Hey there, future millionaires. Investing might seem intimidating, like a club for Wall Street hotshots, but guess what? It's not. Investing is for everyone, and it's the key to growing your money. Before you dive in, you need to learn the lingo. Think of it like learning a new language, the language of money. Once you understand the basics, you'll be well on your way to building wealth. Don't worry, I'm here to break it down for you. We'll cover the essential terms every new investor needs to know. By the end of this guide, you'll be speaking the language of finance like a pro. Ready to get started? Let's do this. Just like any new skill, investing comes with its own set of terms and jargon. These terms might seem overwhelming at first, but they are the building blocks of your financial literacy. Understanding them is crucial to navigating the world of investments effectively. But don't let that scare you. Everyone starts somewhere, and with a bit of effort, you'll soon find these terms becoming second nature. Once you understand the language, everything else becomes much clearer. It's like having a map in a foreign city. Suddenly, you know where you're going and how to get there. Think of it like learning to cook. When you first start, the recipes might look like a foreign language, but with practice, you begin to understand the terms and techniques. You need to know what sauté or simmer means before you can whip up a delicious meal. Similarly, in investing, terms like diversification, equity, and yield are essential to creating a successful portfolio. The same goes for investing. Knowing these terms is like having the right ingredients and tools in your kitchen. Without them, you're just guessing and hoping for the best. Knowing the key terms helps you make smart decisions and cook up some serious wealth. It's about making informed choices that align with your financial goals. We're going to break down these terms into bite-sized pieces so you can easily digest them. Just like a good recipe, we'll take it step by step. Ready to expand your financial vocabulary? Let's get started. Remember, knowledge is power. The more you know, the better equipped you'll be to handle the ups and downs of the market. The more you understand these terms, the more confident you'll become in your investing journey. Confidence leads to better decisions, and better decisions lead to financial success. So, let's dive in and start speaking the language of money together. Ever wanted to own a piece of your favorite company? Imagine being more than just a customer, but an actual part owner of the brands you love and trust. That's what stocks are all about. Stocks represent ownership in a company, and owning them means you have a stake in the company's future. When you buy a stock, you're buying a small ownership stake in a company. This means you get to share in the company's profits and growth. Think of it like buying a slice of a giant pizza. Each slice represents a portion of the whole pizza, just like each stock represents a portion of the company. The more slices you own, the bigger your share of the pizza and the profits. Owning more stocks means you have a larger claim on the company's earnings. Companies sell stocks to raise money for things like expanding their business or developing new products. This capital helps them grow and innovate. As a stockholder, you become a part owner and share in their success. You might even receive dividends, which are a portion of the company's profits paid out to shareholders. Of course, just like any business, companies can have good times and tough times. The stock market can be unpredictable, and the value of your stock can fluctuate. The value of your stock can go up or down depending on how well the company is doing. It's important to stay informed and understand the risks involved in investing. Investing in stocks requires research and a good understanding of the market. It's not just about buying and selling, it's about making informed decisions. Many investors use tools and resources to track their investments and make strategic choices. This can include financial news, stock analysis, and advice from financial advisors. By staying informed and making smart decisions, you can increase your chances of success in the stock market. Remember, investing is a long-term journey, not a get-rich-quick scheme. So whether you're a seasoned investor or just starting out, owning a slice of something big can be an exciting and rewarding experience. Happy investing. Bonds are a bit different from stocks. Instead of owning a piece of a company, you're lending money to a company or government. Think of it like giving your friend a loan. They promise to pay you back the money with interest. That interest is your reward for lending the money. Bonds are generally considered less risky than stocks. That's because you're more likely to get your money back, even if the company or government isn't doing so well. However, because bonds are less risky, they also tend to offer lower returns compared to stocks. It's all about finding the right balance between risk and reward. Diversification. Don't put all your eggs in one basket. You've probably heard the saying, don't put all your eggs in one basket. This age-old advice is not just for farmers or those handling fragile items, it holds significant wisdom for investors as well. Well, the same goes for investing. When it comes to managing your finances, putting all your money into a single investment can be incredibly risky. Diversification means spreading your money across different types of investments, like stocks, bonds, and real estate. By doing so, you are not overly reliant on the performance of one particular asset, bonds, and real estate. Each type of investment has its own set of risks and rewards, and by combining them, you can create a more balanced and stable portfolio. This helps reduce your risk. Diversification acts as a buffer against the volatility of the market, ensuring that your financial future is not tied to the fate of a single investment. Think about it. If all your money is invested in one company's stock and that company goes bankrupt, you could lose everything. This scenario is a nightmare for any investor, but it can be avoided with proper diversification. But if you have a diversified portfolio, even if one investment performs poorly, the others can help cushion the blow. This way, the impact of a single underperforming asset is minimized. Diversification is like having a safety net for your investments. It provides a layer of security that can help you sleep better at night, knowing that your financial future is more secure. It helps you weather the ups and downs of the market and come out ahead in the long run. Over time, a well-diversified portfolio can lead to more consistent and reliable returns, helping you achieve your financial goals. Remember, the key to successful investing is not just about picking the right stocks or bonds, but also about managing risk through diversification. By spreading your investments, you are better positioned to handle market fluctuations and unexpected events. Whether you're saving for retirement, a child's education, or a dream vacation, diversification can help you reach your financial milestones with greater confidence and peace of mind. So the next time you think about investing, remember the wisdom of not putting all your eggs in one basket. Diversify your investments and build a more resilient financial future. Risk tolerance. How much can you handle? Risk tolerance refers to how much risk you're comfortable taking with your investments. Are you a daredevil who loves the thrill of a roller coaster? Or do you prefer a leisurely stroll in the park? Your risk tolerance will determine what types of investments are right for you. If you're someone who can stomach big swings in the market, you might be comfortable with riskier investments like growth stocks. But if you prefer a smoother ride, you might opt for more conservative investments like bonds. There's no right or wrong answer. It's all about finding what aligns with your personal risk appetite. Return on investment, ROI. Your scorecard for success. Return on investment, or ROI, is how you measure the profitability of your investments. It tells you how much money you've made or lost on an investment relative to the amount you invested. Think of it like your scorecard in a game. A higher ROI means you're winning. For example, if you invest $1,000 and your investment grows to $1,100, your ROI is 10%. That means you made a 10% profit on your initial investment. Not bad. Compound interest, the snowball effect. Compound interest is like the magic of investing. It's the process of earning interest on your interest, which can lead to exponential growth over time. Think of it like a snowball rolling down a hill. As it rolls, it picks up more snow and gets bigger and bigger. That's compound interest at work. The earlier you start investing, the more time your money has to compound. Even small amounts invested consistently can grow into a significant nest egg over time thanks to the power of compounding. Remember, time is your best friend when it comes to investing. Time horizon. Patience is a virtue in investing. Time horizon refers to how long you plan to keep your money invested. Are you saving for a down payment on a house in a few years, or are you investing for retirement decades from now? Your time horizon will influence your investment strategy. If you have a long time horizon, you can afford to take on more risk because you have more time to recover from any potential losses. But if you have a short time horizon, you'll want to be more conservative with your investments because you have less time to make up for any losses. Inflation, the silent thief. Inflation is like a sneaky thief that slowly eats away at the value of your money over time. It means that the same amount of money buys you less goods and services in the future. Think about how much a gallon of milk cost 10 years ago compared to today. That's inflation at work. As an investor, you need to make sure your investments are growing at a rate that outpaces inflation. Otherwise, you're actually losing purchasing power over time. Take control of your financial future. There you have it, folks. You've just learned some of the most important investment terms. Now it's time to put that knowledge into action. Don't wait another minute to start investing in your future. The sooner you begin, the more time your money has to grow. Remember, investing isn't just about getting rich quick. It's about building a secure financial future for yourself and your loved ones. Ready to take the next step? Head over to our first guide in this series for a beginner-friendly introduction to the world of investing. Keep learning, keep growing. Congratulations on taking this important step towards financial literacy. Remember, learning about investing is an ongoing journey. The more you learn, the more confident and informed you'll become as an investor. So keep reading, keep asking questions, and never stop learning. Investing can be incredibly rewarding, both financially and personally. It empowers you to take control of your financial future and create the life you've always dreamed of. Now go out there and make it happen. And if you haven't already, make sure to watch the first video of this series to get started on the right foot. Hit the like button and smash that subscribe button because I'm rooting for you.